Imagine waking up tomorrow morning to breaking news. The United States and Iran are officially at war. Oil prices explode overnight. Stock markets plunge. Global shipping routes freeze. But while everyone is watching the stock market crash, something strange starts happening in the U.S. housing market. Homes in certain cities start selling even faster. Prices in some areas refuse to fall, and in a few places, they actually start rising. Why would housing behave like this during a war? Because when global conflicts begin, the housing market doesn't follow normal rules. And if a war with Iran happens, U.S. housing prices could move in 3 surprising phases that almost nobody is talking about. The first phase begins within hours of the first missiles being fired. When wars start, the economy reacts immediately, and a war involving Iran would trigger one of the biggest economic shock waves in decades. Why? Because Iran sits next to one of the most important choke points on Earth, the Strait of Hormuz. Roughly 20% of the world's oil supply moves through this narrow passage. If shipping is disrupted, oil prices could surge overnight. Now think about what happens next. When oil prices rise, everything else becomes more expensive. Transportation, manufacturing, electricity, construction, food production. In other words, war instantly fuels inflation. And inflation is one of the biggest forces that drives housing prices. But here's where things get complicated, because higher inflation usually pushes mortgage rates higher too. And when mortgage rates rise, homes suddenly become much less affordable. So at first glance, it seems obvious. War should cause housing prices to collapse, right? But history suggests something very different. And the next phase of the housing market reaction is where things start getting interesting. Whenever global conflicts erupt, financial markets become unpredictable. Stock markets swing wildly. Investors begin moving money out of risky assets. And during uncertain times, investors hunt for something called safe haven assets. Traditionally, those include gold, government bonds, land, and real estate. And over the past several decades, U.S. housing has increasingly been seen as one of the safest places to store wealth. Think about it. Even during economic chaos, people still need somewhere to live. Homes produce rental income. Land cannot be printed like money. And large institutional investors know this. Companies like BlackRock and Blackstone have already invested billions of dollars into residential housing. During a geopolitical crisis, those institutions may actually increase their real estate exposure rather than reduce it. Because while stocks may crash, real estate tends to move much slower. And that slower reaction creates the second phase of a wartime housing market. A strange moment when buyers hesitate, but prices don't immediately fall. Instead, something else begins to break. The real pressure on housing during wartime doesn't come from buyers, it comes from builders. Home construction depends heavily on energy. Heavy machinery runs on fuel. Factories producing cement, steel, glass, and insulation all rely on massive energy consumption. When energy prices spike, building homes becomes significantly more expensive. Developers suddenly face higher costs for steel, copper, insulation, fuel, and shipping. And if global shipping routes are disrupted, material shortages can get even worse. This means many developers delay projects, some cancel them entirely. And when builders stop building, future housing supply shrinks. This is exactly what happened after several global shocks in the past. Even the housing disruption during the COVID-19 pandemic caused massive construction delays. And those delays helped push housing prices dramatically higher in the years that followed.
But a war could create an even stronger supply shock, because energy prices would surge at the same time construction slows down, and this leads to the third phase. Once construction slows, the housing market enters a strange stage. Demand doesn't disappear completely, but new homes stop being built at the same pace. Meanwhile, millions of Americans still need housing. Families grow, people relocate for jobs, immigration continues, and the United States already has a massive housing shortage. Estimates suggest the country may already be short millions of homes. So if construction slows further during a war, that shortage becomes even worse. And shortages create something powerful in economics: price pressure. This is why housing markets often behave differently from stock markets during crises. Stocks can collapse instantly, but housing moves slowly, because supply cannot adjust quickly. And when supply becomes constrained, prices can remain surprisingly strong. But there's another factor that could dramatically shape housing during a war with Iran, and it involves interest rates. To control inflation, the Federal Reserve raises interest rates. Higher rates make borrowing more expensive. Mortgages become harder to afford. Monthly payments rise, and this reduces the number of buyers who can qualify for loans. But here's the twist. When mortgage rates rise sharply, many homeowners refuse to sell. Why? Because millions of Americans currently have mortgages locked in at extremely low interest rates. If they sell their homes, they would have to buy another home at a much higher rate. So instead of selling, they stay put. This phenomenon is sometimes called the housing lock-in effect, and it can freeze the market. Fewer buyers, fewer sellers, and fewer new homes being built, which means housing supply tightens even further. So if a war with Iran were to begin tomorrow, the housing market might move through 3 phases. Phase 1, shock. Markets panic, mortgage rates rise, home sales slow. Phase 2, freeze. Developers slow construction, homeowners stop selling, inventory drops. Phase 3, pressure. Housing shortages deepen, demand stabilizes, prices begin climbing again. And this is why housing markets often behave differently from other financial assets during global crises. So remember the question from the beginning. If a war with Iran starts, will U.S. housing prices collapse? History suggests something more complicated. Instead of collapsing overnight, the housing market could move through a strange cycle of fear, scarcity, and pressure. And in the long run, the biggest risk may not be falling prices. It may be that homes become even harder to afford than they already are.